Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 13th of June 2021. Recently there's been some interest in the lumber gold ratio, and the interest has been in particular with its ability to foresee a stock market crash. Does it actually work? And if so, how should we use it? This idea was developed by Michael Gayed in the lead lag report shown here. And I've put a link to this original paper in the description for those who are interested in reading it in more detail. Now, this was originally published in 2015, and according to this, it was again updated in November 2020. The aim of this paper was to describe a method for deciding when it's appropriate to take more risk with the equities market and when to take less risk. And the aim of this is to outperform. Now, an ideal portfolio would be risk on at market bottom, so like here and here, and you want to be risk off at market tops over here. And the aim of this is to basically maximize your returns, and Michael proposes a way of doing this. Housing uses a lot of lumber, and in most Western countries, housing is the primary store of wealth, and it also influences the level of consumer spending. Housing permits are therefore considered to be a key leading economic indicator. This is a chart showing new housing permits, and in grey, the grey vertical lines, those are shown the recessions. Note that every single recession has been preceded by a steep drop in housing permits. So here, the recession started here, but you can see the drop started well before then. And again, the same here, recession here, a drop in permits before, and again here and here as well. In fact, this actually dropped substantially before the recession actually hit. However, a drop in permits is not always followed by a recession, and so it can give false signals. So we've got some examples here. We had a drop here, quite a large drop over here, and there was no recession kind of in the near term from there as well. The demand for lumber is sensitive to housing activity, and it's been shown that lumber futures react quickly to housing starts data. So let's have a look at this. So here we've got that housing starts data in blue, and in red we've got the lumber price. If we hone in on those recession times, so the recession over here in 1970, the permits dropped over here, and actually the lumber price dropped at around the same time. It didn't really precede it, but it was, pretty much at the same time there. And over here, we've got this peak over here in the permits, and actually here lumber prices didn't drop. They actually rose into that. So that was an incorrect signal there. What about this big recession over here? So the permits dropped here. Lumber prices are actually flat there. And then looking at this one, again, we had a big drop in permits here. There was not really any big preceding drop in the lumber price there. It's actually pretty kind of sideways, wasn't it? Over here, I think this is a short recession, so look, let's move on to the next one. So we had a massive decline in permits over here, and this was actually a really good signal because lumber prices began to decline before the permits there. So that was really good there. And over here, we had a big decline in permits. There was no preceding decline, I guess, unless you include this one. So it's kind of so-so regarding that side of things. Overall, it was concluded that the lumber price is a leading indicator of housing activity consumer demand, economic growth, and inflation expectations. And so lumber was said to be a signal of risk seeking. In this paper, gold was considered to be an uncorrelated asset with no significant correlation to equities, bonds, or to macroeconomic parameters such as GDP, inflation, or interest rates. Now, this is one area that I actually disagree with the paper. Gold has been shown to be strongly correlated with real interest rates, with a correlation coefficient of over 0.8. So that's quite a strong correlation. The paper also states that gold is only a safe haven after extreme negative stock market shocks. I'm not sure I agree with that either, since there are multiple drivers for gold. And, what about things like high inflation? It's also been said that gold is purchased in anticipation of rising equity market volatility. Gold is a non-cyclical asset, and the paper basically concluded that gold signals risk aversion. Now, again, I don't entirely agree with a lot of these statements. This chart shows the VIX in black, and in orange is the gold price. In the bottom here, we've got the correlation coefficient between those two parameters. And looking at this, they don't look particularly correlated to me. And if you look over here, you can see that as the VIX is dropping, the gold price is actually increasing, which is the opposite of what the paper was suggesting. To summarise, in this paper, lumber signals a risk-on environment and gold signals a risk-on environment. But as I said, I don't completely agree with the latter assumption in particular. This is the chart of the lumber to gold ratio, and this goes back to 1973 here. And at the bottom here, I've drawn the correlation of the ratio to the gold price. Now, you can see that most of the time the correlation is negative, but interestingly, in the last 6 years or so, there's not actually been a consistent correlation. It kind of flips between positive and negative and isn't particularly strong in either direction. So it's been very variable. In contrast, the correlation between the lumber-gold ratio and the lumber price is much stronger. So you can see that here most of the time it's pretty close to 1, and it's been like that for decades. So to me, this says that the lumber price is the primary driver of the lumber to gold ratio. Interestingly, we do have an anomaly here, and that was in the 1970s, where we got a very different correlation here. It was actually negative for a significant time. Going back to the original paper, the following trading strategy was proposed and was backtested. If lumber outperforms gold in the prior 13 weeks, take an aggressive stance in the portfolio for the following week. If gold outperforms lumber in the prior 13 weeks, take a defensive stance in the portfolio for the following week. Re-evaluate on a weekly basis. Why is this strategy warranted? Well, the reason is that it's said that lumber outperformance forecasts a low VIX, whereas gold outperformance forecasts a high VIX. The paper goes on to outline various trading strategies, such as rotating between small caps and bonds or between NASDAQ and bonds. And they describe a few other trading strategies as well. But basically, you rotate between those depending on the risk-on or risk-off signals that you get. Backtesting showed that the lumber-gold ratio trading strategy led to an average of 6.6 rotations per year. They found that this strategy actually outperformed a passive buy and hold strategy by 3% per year, And actually in the inflationary 1970s, it was 2.8% per year. The strategy led to participation in 60 to 64% of the upside, and the downside was limited to 18 to 25%. Now, this is a really important point to think about here. It tells us that this isn't going to just get you in and out of the market at the tops and bottoms. This chart shows the lumber to gold ratio in the bars and the S&P 500 in black, and I've marked out 3 examples of major stock market declines. Regarding the ratio, remember that a drop in the ratio means that gold is outperforming lumber, suggesting risk off and, in theory, forecasting a drop in the equities. Now, we can see that in the mid-2000s here, the ratio dropped substantially for 2 years before the stock market actually declined significantly here. However, if we use the prescribed strategy as stated earlier, then you'd have had rotated in and out of the stock market at least 12 times over that 2 years. And you would have avoided the bulk of this drop that occurred in 2008. It also looked like it worked in 2018 over here. So you can see that there was a big decline in the ratio that occurred in advance of the equities dropping. So that actually worked quite well then. But it's not so clear for the crash that occurred in 2020. So here you can see that preceding that crash, it actually looks like the ratio went up and then was flat in those 13 weeks before the crash occurred. So it doesn't look to me like it forecasted that crash there. The paper does acknowledge that the ratio indicator isn't perfect. So for the top 1% of the worst weeks for the S&P 500, the indicator triggered 89% of times before that big decline. That tells us that it's pretty good, but it's not perfect. What I'd also really like to know is the frequency of false triggers, i.e. when the indicator triggered and there was no big decline. Whenever retail investors come across a new indicator or strategy, it's really common to get all excited about it and think, yeah, this is it. This is the one. And it's also common for retail investors to try out, and often they get disappointed. Now, it's not that the authors of such strategies have been misleading in any way. No, I don't think so. There are multiple reasons why things may not work out quite as the backtesting would suggest. Backtesting suffers from numerous biases and flaws, and I think forward testing is far more valuable. Given that this paper was originally written in 2015, it would have been really useful to see the results of forward testing from 2015 to present and have that as a separate data set. That would be really useful. Another misunderstanding is that retail investors might use the strategy intermittently rather than consistently. And that's not going to give you the same results. So this study used the indicator consistently over long periods of time in a kind of robotic way, really. So this is a kind of bot strategy. If you veer from that, your results will differ. Although this strategy outperforms by 3% a year, note that it does require multiple trades and rotations per year. And so I'm wondering, do the things like taxes and fees affect those gains in the final result? Other things to consider are that there's no specific ratio value that tells you that a crash is coming. It's not that kind of indicator. The magnitude of outperformance of gold or lumber is also not relevant here. It's the direction over a specified time period. All strategies involve assumptions, and we do need to identify what those assumptions are, and we need to decide for ourselves whether we believe those assumptions are likely to be correct. And finally, as with everything in the markets, we're always dealing with probabilities, not certainty. Next up, the market update. Well, we had the US inflation figures out last week, and it sounds like inflation is running hot in USA at 5%. Anyway, I looked up some tables, and apparently in the UK and New Zealand, it's only 1.5%. And for those of you living in Australia, it's only 1.1% apparently. Anyway, and even more bizarre, inflation apparently makes gold go down. Everything's all topsy-turvy these days, isn't it? Anyway, this whole relationship is probably transitory, isn't it? Okay, let's start with gold priced in US dollars on the daily scale. And yeah, things haven't changed a lot really since last week. This is getting quite boring at the moment, isn't it? But boring is good. The more boring it gets, the bigger the ensuing move, because it catches people unawares. To me, this looks like this is consolidating, and I think we've still got a few more days of this sideways movement. And what we're looking for is a break to the upside above here. As you know, I'm still bullish here. And as I've said, I think we're going to hit a bit of a roadblock around this 1960 level because of the previous price action. I've also drawn this trend line here, and this should hold. If it does break, it'll just, I'm expecting it only to be a minor break really. I think this is going to go to the upside eventually. I thought I was playing around a little bit with volume by price. So what I've done here is use the volume by price tool on TradingView and started at the peak price here, which was back in August last year, and use the price action to current levels. And as we can see, you can actually see that the volume was highest over here, which is where we've kind of stalled really around that area as well. So I thought that was quite interesting. And even here we had a high volume area here, and that kind of fits with this area over here where there was quite a bit of stalling a couple of times over here. So what does that mean going forwards? Well, we're still at this area here. So I think once we break out above this 1900, you can see we've still got some pretty large price volume bars over here as well. And that fits in with that 1960 kind of area as being an area that we're going to get stalled again. Above that, of course, it looks like there's thin air really. And note that this area is blue sky territory in terms of prior price action. This is the only time we've ever hit these prices in history. In these nominal terms anyway. So yeah, I think what's going to happen eventually after we've got out of this consolidation, whether this is a triangle that's forming, and although I've drawn the top slope here, this trend line doesn't necessarily mean it's the bottom part of the triangle. Sometimes the triangle can be more like this, in which case we can dip just below that trend line, as I mentioned. So it could be that price kind of does this a little bit before breaking out. So I think, you know, it could be another week of this kind of movement. I'm not sure. But yeah, once we hit here, I think we're going to hit this area before bouncing back down again. And we'll talk about how far we think that's going to bounce down a little bit later. But yeah, it's happened before. I think it's likely to happen again. And this adds extra kind of confidence to that as well. Let's move on to silver priced in US dollars on the daily scale. And here what I've done is join these two highs over here, and I actually cloned that line just to see what happens and moved it, and it fits perfectly with these two lows. So looks like it's forming a flag formation over here, and we've had two touches of the bottom and two touches of the top. I'm expecting this to have another go at this top, and this over here seems to be a confluence here, and this is kind of where we need to break through really to move on upwards there. So that's the area that I'm looking out for. I am expecting an upwards move for silver. I'm not expecting this to come back down at this stage, down to 27. But let's see. It's still early days. This 28, it looks like pretty tough overhead resistance, but it's really trying to get through there. So I think we're looking at about this 28.40 roughly level. If we can get above there, I think we're going to get some pretty fast movement upwards. And I've done the same thing that I did with gold, and again did the price by volume from the peak here. And again, it gives us a pretty good view here. So the highest volume here is where we've stalled, roughly over here. And so we've got these two bars here that we're kind of battling through. Once we get above this level, and so again, that fits in with this area here that I'm talking about, it's pretty thin air over here. So I think once we break above this, we're going to get quite a fast move up towards just above 30. And that's where I think we will get the knockback. It might happen before that. It's hard to say. But yeah, I think we're going to get a quick move and then a rejection at that point. Moving on to the gold miners. So this is the GDX on the daily scale. And last week I'd drawn this trend line here, and we talked about this triangle that had formed, and we're wondering either whether that's a triangle or we're getting a flag formation. I think that was a triangle, and last week we'd broken down and bounced up, and then the pattern resumed downwards again. It didn't quite reach target though before bouncing back up. The target was actually a bit lower than that. But yes, it still seems to be quite resilient. It's kind of moving sideways at the moment. And why has this been a stalling point? Well, we've got all of this price action here that we need to work through. But I'm still positive about the miners. I still think we're going to end up turning around. We just got to wait for the gold price to turn around for this to start moving as well. But yeah, I'm expecting an upwards move here. And this is looking at the HUI to gold ratio. So this is how the miners are performing. And when the miners are outperforming gold, you would expect an upwards direction movement. As you can see, for a long time now, the miners have been underperforming gold in general, and we've been in this down-sloping trend line here. Hasn't been able to break through that so far, but the last attempt here got rejected, but we're going again for another attempt here. So I think pretty soon we're going to break through here, which would suggest that the gold miners are going to outperform gold quite significantly. I think once we break above here, there's quite a fair amount of room for upwards move with this. And here we have the silver junior miners. That's the SILJ on the daily scale. And yeah, this has been pretty boring for quite some time, but this is the area that we've been looking for, breaking through here. Now we had a false break here, and we've had false break over here as well. So this is pretty strong overhead resistance, but the good thing is that it's been hanging around this end of this triangular shaped pattern. I would get worried if we start heading down here. Below 17 would be worrying, and below 16, yeah, I'll get very, very worried there. But I just don't think this is going to happen. This is looking pretty strong. we had a little knockback on the last day here, but I just think this is going to turn around and break through. And when it does, it's going to be spectacular. And this is the SILJ to silver ratio. So this tells us how the silver junior miners are performing relative to silver. And this seems to be consolidating in this kind of triangle shape. This is a symmetrical triangle, and usually you get the breakout around 70, I think the statistics show it's 74% along the length of the triangle. So I measured this, and 74% comes out around the end of next week, so around here somewhere. So again, we might move a little bit sideways for a few days, and perhaps towards the end of the week we can see a breakout. If it does take longer than that, then actually sometimes that can mean a stronger breakout, and I'm expecting this to break out upwards, in which case the silver junior miners are going to do a spectacular price move, which would fit in with the SILJ chart as well. Interesting. This has been rather nail-biting though, hasn't it? And I reckon I've kind of reached peak boredom with the price action. I'm sure many of you have, but that's actually not a bad thing. I actually take notice of that when I'm getting a bit fed up of looking at the price and it's always the same, kind of moving sideways for quite some time. And I'm almost when I notice I'm almost to the point where, oh, I can't bother to look at it anymore. That's usually when a big price move happens, and I kind of feel like we're getting close to that kind of stage now. Peak boredom, that's what you want to look for. Well, that's it from me for this week. Hope you all have a great week next week. All the best. See you next week. Bye.